I see where it's a practice to now webinar. Okay.
Yeah. We got some folks joining. Hey, everybody. Just letting some folks trickle in. So I just started a poll for those of you that just joined as we wait for folks to come in. If you could fill that out quickly, just a few questions, just for us to get a sense of how familiar the audience is with ARR Waterfalls, that'd be great. And that's just in the poll button at the toolbar at the bottom. Okay, we can start it here pretty soon, but a reminder for folks who just joined, we have a poll going. If you guys could fill that in before we kick off, that'd be great. Seeing a pretty broad smattering, which is what I expected. So, Will, this is as much for you as anyone, but it looks like a range of familiarity with ARR Waterfall. So some folks, they've heard of the ARR Waterfall, but couldn't tell you much of the details. A couple folks understand the concept, but not how to kind of calculate it in practice. One just came in, doesn't know what an ARR Waterfall is. So I think the agenda here is a good one of kind of covering the gamut. And same with the second question. Some folks are more interested in overall overview and some in how to use it for action. So I think we are well suited for this conversation. So let's get started. I ended the poll there. Great to see all of your names here that joined. Thanks for taking the time. Again, I'm James, the co-founder of Accounting. So just quick background, we are the planning and analytics platform built for RevOps teams, helping connect fragmented data, snapshot it, turn it over time without any data engineering. I'm really excited about today's topic, which is, of course, ARR Waterfalls. With Accounting, we've seen this use case coming up more and more with our customers who are having trouble not only pulling it together, but actually making sense of the ARR Waterfall. And so we were lucky to come across who I believe is the leading expert in putting AR waterfalls together, at least the best I've seen, and that's Will Sullivan, who we have here. So, Will, I'll frame up our agenda here shortly, but first, do you kind of want to share your background for folks?
Hey, James, thanks. Glad to be here. Yeah, I run a firm called Predictive Analytics Partners. We help PE-backed companies get exit ready and help them with M&A transactions, as well as with value creation and driving to revenue efficiency, which I use net retention rate as a proxy of that. So a lot of metrics. Inherently, I have operations background and M&A background. I did about 25 tech deals from 21 to 23 while at PwC. And so I used to build these day in and day out over and over again. And for those that are becoming familiar with ARR waterfalls in the consulting world of Big Four, everyone agrees it takes about 12 months or more to get a good understanding of ARR waterfalls, and another 18 to 24 months to really become an expert on this. So I think there's probably about 24 of people like myself that do this. Most of them are Big Four, but I'm happy to share my learnings today.
And so instead of 12 months, we're going to get everyone completely up to speed in 25 minutes, right, Will?
I'm gonna have a lot of people asking questions.
That's great. So Will, if you want to kind of start bringing the slides up, I'll just cover the agenda real quick. And so today we're going to cover just the basics of what is an ARR waterfall to start. We'll get into a brief overview on how to calculate it. And then what's really interesting to me personally is the benefits for RevOps. So both tactically and strategically, how can you use this ARR waterfall to your advantage? And then finally, when should you think about implementing a waterfall from kind of a company or RevOps maturity readiness perspective? And Will just mentioned it. We'll save some time for Q&A at the end, but feel free to post questions in the chat or in the Q&A button at the bottom here of Zoom. And, I'll monitor them. I'll bring them up to Will as I see fit, or we may save them for the Q&A portion at the end. So without further ado, Will, do you want to kind of take us forward here?
Yeah, I know James called this the secret weapon of RevOps. I think about it as that secret weapon allows us to power strategic revenue growth. And why it's important is because for a CRO or a RevOps team, to really work cross-functionally with finance. You got to speak their language and show he can drive growth. So let's just get right into it. There you go. Here's the agenda. What's an ARR waterfall? How to calculate it? What are the tactical and strategic benefits? And then when in a RevOps evolution should this be implemented? All right, let's dive right in. I'm sure most people here have seen an ARR waterfall chart. It's actually a bridge chart, which is going from one period to the next and showing the movements. And this is kind of referred to as a waterfall or a bridge. You got some negative movements, some positive movements. But most people don't know what goes behind this and how this was built. And that's the ARR waterfall table, which is a visual ability to visualize customer ARR movements over time. And so that time period is both within the period and across period, which is very powerful. However, looking at absolute numbers is difficult, which is why I do the analysis with relative numbers, looking at percentages of the beginning. So 5 is, so this churn is 6.3 because it's 5 divided by 80. And that's how you get to this percentage of the beginning. And that makes it much more tangible to look at. But let's kind of go forward. I'll come back to analysis.
And I kind of real quick, Will, just want to tease the benefits here because we're going to go into the calculation here, which is super important. But to me, like data like this is how RevOps becomes a truth teller for the business. And so in the Boardroom RevOps podcast that I hold, I've had a number of CEOs, VPs of RevOps on the podcast talking about how did you make it there? Like how does RevOps elevate itself as a strategic function? And in the upcoming episode, actually, it's super relevant. I asked this three-time CEO, when did RevOps wow you? And he gave an example where the RevOps lead kind of dug into data on their own and found out a truth about the business where the business was operating incorrectly. They thought their sales cycle was 4 months. He dug into the data, found out it was actually 3. And that wasn't showing up in reports. It wasn't showing up in the conversations from execs. This is very similar to me. I think it's so easy for leadership to unintentionally or intentionally spin a narrative about certain things improving in a business, expansion, churn, onboarding success, things like that. But it's only when you get deep into like really powerful data that's hard to get to that you and RevOps can actually corroborate that or actually disprove it. And so I think stuff like this is super important. And so I just kind of wanted to tease that and frame it up before we get into the nitty gritty.
Yeah, it's great. There's a lot to cover in here, and I'll show you how I look at sales motion analysis, which is one of my favorite ones as well. But once again, like there's about a dozen metrics in here, and this is a framework to show them. And that's why it's so powerful. You can think about it as customer purchase behavior journey. And we'll get into that some more. So why is it so important? When you go to sell your business, go to acquire another business, this is what you're going to look at. You're going to look at an ARR waterfall table, and you're going to look at the net retention rate, and that tells you how sustainable the revenue is. Why is it sustainable? Because it's already from customers that are working with you as opposed to acquiring new customers. And the easiest way to grow revenue and most efficient way is to sell more to your existing customers, which is why net retention is so important. And that this framework allows us to drive performance of expansion, customer retention. We can analyze customer purchase behaviors. And when we look at it from a multi-dimensional aspect of market, segment, vertical, cohort, sales motion, lead source, you can really understand go-to-market effectiveness. All right, back to the table. Let's just kind of walk through what are the components of revenue growth and how this table shows it to us. Now, there's a whole bunch going on here. Let's make it simple. When you look at the net churn of starting beginning ARR plus churn, product churn, downsell, upsell, and cross-sell, we get this net retention rate, excuse me, organic growth. We get net retention rate, which is an example of organic growth. And that's where we get this calculation of simply 100 because we went up by 11 and dropped by 11. When we think about inorganic growth, it comes from acquiring new ARR and then this idea of lapse and returning. And for most of y'all who've seen ARR waterfalls, if you see lapse and returning, and we see this unit analysis at customer product level, that's a signal. This is a very advanced waterfall. And so I'm showing you this most advanced one. Lapse is when a customer does not renew on time. That could just be because of a credit card issue. It could be an enterprise account that takes a little bit longer to review and decide to renew. but they eventually do come back and renew within the same period. Now, a returning customer is your traditional win back. This is a customer that left a prior period, it could be a year or two ago, and comes back. And we don't give the credit to new because we've already acquired them once, so it's less expensive to acquire them again. All right, I'm going to talk about net new ARR. So we can look at within the period from 100 to 112, it grew by 11.5. This is really where the evolution of ARR waterfalls have gone in the last few years. Usually, you just look at movements and look at churn. Is it increasing or decreasing? And what's net retention? But net new ARR is what a lot of CROs and CFOs are setting compensation models towards of driving net new ARR. But that's getting a little advanced. Let's kind of go into how to calculate this. And James, jump in if you have questions because this is complex. So there's three key considerations when you're going to build an ARR waterfall analysis. And these are the nuances that bite everybody in the ankles, if you will. So the source you start with, is it going to be from a bookings database like a CRM? Is it going to be from a billings database like a point of sale tool such as Stripe? Or is it going to be from a revenue database where RevRec has already been applied for ASC 606 or IFR 15, which is a
And
Europe.
Will, is
Yeah,
it common in your experience for it to be a blend of these? That's something that we see for our customer base, at least.
it
We're
shouldn't be
often
a
kind of
blend.
combining it together. Okay,
You
interesting.
should not blend these. And so what you do, ideally, you'd use a revenue database. Now, once again, if you're a low dollar credit card kind of payment almost, it's really easy to use a billings database. You use a revenue database when you have to charge a portion up front for implementation. Uh, and then you have to correct that over time so revenue is recognized in the period. Or if there's a multi-year contract where you have to show it on a annual basis. But if you, most companies would do a ARR waterfall pulling from Salesforce or HubSpot, and they're using a bookings database. And that's what ARR is calculated, total contract value divided by duration. And so that's the one you see most often. The challenge on that, and James, you brought this up before the call, is when you do often use contracts database, you're not seeing product level. It's just a lump sum. And this gets back into Salesforce hygiene and Salesforce granularity, which is why I like doing them at the billings, which is most common. It's just it's kind of standard. People have this, and there's going to be some sort of nuances, but it's especially for operational analysis, you do it on an MRR basis, and it's straightforward. You don't blend them. You'd actually reconcile. Actually, don't even try to reconcile back. It's complex. Let the big four or someone like myself handle that.
Good to know.
All right, let's do unit of analysis. That was a lot of detail. This is really the other big complexity here is what level are you analyzing the movement of AR? Is it a customer level or a customer product level? Let me be clear. Customer level is still very complex. It's just less complex than doing it at a customer product level. And in that regard, you have to decide what is the customer and what is the product. And there are hierarchy considerations such as parent account, ultimate parent, parent, then account and subscriber, or product line, product, or SKU. So you have to have a knowledge and understanding of the business, and you may have to do a few cuts to figure out what's the right unit.
And Will, you just touched on this a little bit with the source. And I think for this revenue operations audience, like let's just assume it's the CRM is kind of the source of data we're using here. Again, maybe it's a maturity thing. We have customers who are come to us for cross-sell analytics because it's actually hard for them to visualize which customers are using which product. So do you have any kind of high-level advice
Yeah.
for how the CRM should be structured from like a customer product standpoint? Is there a best practice you've seen?
Yeah, it's if you're using CPQ or some sort of contracting tool, you got to make sure you got a line item in there for product. So it's not just you're not just analyzing a contract on a lump sum basis. You actually see product A was $100, product B was $50, and product C was 25. And you sum that up and you get to a total contract value. And then when you pull from Salesforce, I do an API call often if I'm building in Power BI or Tableau or even Excel with Power Query. I pull the table via an API call and I find that level of granularity at the product level to pull that out. That hopefully answers the question of like
It
CRM
does.
configuration is add the summation and granularity at the product level up to the contract level. Then we get into this engineering aspect of how do you go from seeing a dollar amount of ARR and then understanding the products in it as well. You have to do some transformations. And so you'll often see a transformation tool like Alteryx. Anyone who's worked in the Big Four, that's what they use. You can also use Azure Data Factory and others. That's for like a one-time transformation of the data, or you can do a real-time view and have streaming analytics, and which is what I build, is on a daily basis. You have a real-time view, and that's where you actually have to have these tables come into a data warehouse, which I know Account Aim does. Then you have the data pipelines transform, and you present an analytics tool. I'm gonna pause there, James. What else? Does that kind of answer your question?
I think it covers it. Yeah, I'm sure there's like a million questions we could go into
Yeah.
deeper. And so I think maybe we move forward. If any folks have questions here that are deeper, like send them my way or even to Will, and we can talk shop offline.
So let's just kind of break this down and make it really clear cut. So the customer level analysis, and I am hammering home this unit analysis because it's important, is we see a new customer or new ARR from customer one joined in 2023, and then it decreased their spend, and we lost ARR about 540 into 24. And so the customer level, that's all you would see. You would see a contraction, or some may call it a downgrade or a downsell. I have opinions on that. But inherently, at the customer product level, which once again, this is what is occurring at the highest levels of analysis, you see the drivers of this $1,800. A customer landed on two products. It was a bundled sell. And then the customer dropped product B the following year, but there was an increase in product A. That could be a price increase or a seat increase. There's some sort of upsell. And so that's why customer product level gives you visibility into the drivers of revenue. The best practice is to go with the economic driver of the business, which is not easy because you still have to face this decision of what's the economic driver of the business. Often it's at the account and product level, and but you can also do it at the feature or SKU level, but there's complications in that. No, I'm gonna call. My kid's knocking on the door. All right, so we'll go into this one more time to show the difference. There's a price increase. It's not shown at the customer level, but it's shown at the customer product level. And that's the difference.
Yeah, and so real quick, Will, I think it's been clear, but I just want to up level this a little bit too, because we're now in the weeds around like why is this so important? And to me, this is really allowing folks to like analyze the customer journey and both in aggregate, but and at the customer level really well. So what you showed is the customer hierarchy to start of 1800 to 1260 in this very top row. You might look at this customer and say, things are going really badly, or what happened, or be confused. When you have this product level hierarchy, okay, you see they're actually expanding in kind of our core product A. We lost them on product B. And so, of course, it's business context of what that actually means for the business or the customer. But that's such a different level of insight that you can get at scale with a waterfall like this.
It is. And thank you for bringing that and hammering that home. When you, this I refer to as a customer case study. We can see the details of what they purchased in their customer journey over time. And then we use these terminology of churn, contraction, expansion, and new, or the customer product level to analyze the customer journey at scale. And I want to repeat that. That's so important. Looking at this customer product level ARR waterfall, you can analyze the customer journey at scale by understanding what this customer is doing. And this enables you to understand, is product B the right fit for this customer persona or this market? And when you analyze that at scale, you can start to get into some strategic understanding of the market and the segment, which we'll go on to later in this deck. Got my kid. All right, let's go to tactical benefits. And the best way to do this is continue the analysis throughout this process. All right, so GRR, gross retention, when you see it below 93% for a SaaS company, your spotty sense should go off because kind of industry standards around 7%. So we see that there is a low GRR here, and that signals an issue of churn. And when we look at this net churn, we see it's actually 11%, and that's driven from product churn and downsell. When we compare that to net expansion, we get this flat and we get this 100%. So let's kind of go farther into this. And what I did, right, I took this analysis, pulled it into Excel, opened up the decimals and ran a period to period, and identified, even though these are small numbers, we can actually see an acceleration of upsell and cross sell. And it's actually accelerating faster in expansion. And so what that does, it also makes me think about the growth of this business, 11%, is coming from new customer acquisition. Like I said before, selling to a new customer is more expensive than selling to existing customers. This speaks to the issue of revenue sustainability. And that gets into this idea of revenue efficiency, which is so important right now. And this is where RevOps can bridge the gap with finance. Then you get this conversation of what's the customer acquisition cost of $1 of new ARR? What is our free cash flow from ops doing over this time period? And then what is our cash conversion cycle? Is it healthy or is it decreasing in terms of where we have the ability to sustain double-digit growth, or is there going to be future cash flow concerns? This is what happens when a private equity fund or a strategic buys a company. They do this level of analysis. And the synopsis on this, which would go into an MBR or be delivered to a buyer, I'm just going to read the screen here. Growth is driven by new customer acquisition as customer base growth has flattened. Declining NRR is due to the acceleration of net churn, which actually grew 25% over the last 2 years. This is concerning as net expansion only grew 9%, almost 3 times slower, raising concerns about the company's expansion motion. So we just went through looking at this table and identifying we've got issues with our expansion motion. And that could bring up conversations around, do we have an expansion dedicated team or do we just have a customer service team? And there's a lot of implications you'll go from there. So this is
Yeah.
very powerful to CRO.
And I think, yeah, as a revenue operations professional too, like this is like gold during annual planning, right? So if you're getting top-down directives from the board, who hopefully has seen information like this, but maybe hasn't and is just trying to meet growth goals, this is kind of where you can start to build that plan and see if the assumptions are actually mathing, for lack of better words. And if not, it's, there needs to be some sort of conversation around budget to improve this, whether it's enablement on the expansion motion, more people, a new team, whatever is relevant to the business. It's kind of the starting point for that exploration.
Yeah, and most of the, if we have FP&A people on the call, they will have provided a ARR roll forward, it's the same thing. And they will, it's often shown and looked at to how we generate more net new ARR. What percentage of these movements drive this net new ARR? And that's often where finance people go with this. But when we think about a revenue operation, we think about expansion motion or revenue leakage. And what do we put in place to prevent revenue leakage? And what do we put in place to increase expansion motion? All right, so here's a tactical example going a level down of what I did. I was looking at the net churn of upsell of product churn and downsell compared to upsell and cross sell. And this is a period over period, and it's a visual that kind of jumps out at people saying, hey, this is growing much faster than net expansion, as opposed to saying 3 times. But not just to drive home through a visual, we can also look at forecasting. And once again, this is a statistical forecast, not a bottoms-up build forecast, which is so powerful for RevOps teams to do a bottom-up builds forecast. And now we can look going forward. Oh shoot, if our net retention rate is going to decrease with this variance, we have to be very conscious about what we do going forward. And in that regard, that would drive overall growth significantly lower. Here's another tactical example. And once again, I call this more second layer. We haven't got down into third layer yet, but we can look at the net retention rate by market. And so example here is North America, where this company started, versus Europe. And we see that they entered Europe in 2018. And just using, looking at the colors here, it's a darker green identifies a higher net retention compared to this lighter color. And so it kind of should jump out at you like something's going on in the European market. Why is net retention not we're growing there, not growing as much there, and actually getting down below our gross retention? So we don't have product market fit in Europe. And by doing another layer of analysis, both quantitatively and then speaking qualitatively to head of sales in Europe, we kind of came up with the idea that customers are churning because there's a product that's a competitor there that's in the German language, and our product is only in the English language. This is a real case study. It's happened before. And so I use that as an example here. It's just a quick way to look at by market. And the next thing you would do would be look at where is there any pockets of growth, maybe in a vertical or a SMB or mid-market or enterprise segment, but it's just kind of the second layer down from the table. This one I love. This is the analysis of how new customers are retained over time. And you can think about this as a sales motion analysis. And so refer to land and expand, where you land on one product and eventually expand to a second product, or a bundled sales motion. And because we're looking at the land and expand, I want to look at gross retention, not net retention, because I want to know, are the customers that land on one product stickier than the customers that land on two products? And here, this lighter color is actually higher than this kind of pinkish color. And we can see that our bundled sales offering to close a customer, when we remove this idea of COVID years, it's actually a lot stickier compared to the land and expand motion. And this is so powerful. And I've done this over and over again. Most people think that land and expand is the way to go. When you dig down into it and you really have product market fit, when you land with two products, you become a vital component of that company, and they're stickier and they last you longer.
Well, what's the takeaway past that takeaway, which I think is really salient? Is it companies should lower price to get the bundle? Is it that they
Ooh.
should not be as content of just like taking the easy way out with product A? What's the advice typically?
So it gets back, it gets into go-to-market motion and go-to-market strategy. I am not a fan of discounts. Discounts drive revenue leakage, and most companies don't have good controls and visibility on discounts. So the takeaway here is really honing in your marketing content around B complements A. And our best customers are the fastest growing customers that we work with in this industry. They have A plus B. They have a bundled concept. And so you find this is the case when product A and B are kind of higher in price. And so there's this idea of like, oh, I don't want to spend $500 and another $400 because it's a big chunk right off the bat. But when you drive home the benefits of how B works with A, and this gets into the go-to-market motion of, is it just a bundled discount offering, or are you giving A and B at the same time, and then you take B away 30 days later, almost like the premium to freemium sales motion, where you give someone everything and then take something away, and then they're like, oh, I want that back. And that is always a sales motion I've always loved to do. It's kind of complex, but it drives home product market fit for that customer by using those two products.
That's great.
All right, and here's the just commentary there. All right, James, talk about account aim. So
Yeah. Oh, go ahead, Will.
you can build this in account aim. So account aim allows you to do this by integrating the data warehouse and basically creating its own data warehouse for you. And you have this streaming analytics component. And so Josh and James have built a function to do a simple monthly vintage cohort analysis. And so we see it's by month, by the month a customer was acquired. Oops. And then you take this out to Excel and just simply calculate the gross retention. So 2,750 divided by 5,000, 2,000 divided by 5,000. And then you get back to that conditional cell formatting. You can see it by percentage of the retention over time on a gross basis. And then you would take the cuts by segment. And the beauty of having a tool like Account Aim is you can go in there and add different cuts. You can do the vintage, you can do segmentation, you can do verticals, you can do a number of things here. And now this enables you to do a lot of cuts as opposed to doing a batch process where you're just going back into a spreadsheet or a workflow tool like Alteryx, and it's a 30, 45 minutes to run the tool or it could be a day or two to build the tool. So just a little kudos to account name. James, anything to add?
Yeah, I appreciate it, Will. I think, yeah, two things I would add. One, I think the analytics you showed on the previous slides were all annual, which is the standard and makes a lot of sense. We found a lot of success with customers looking at some of these things monthly to see, especially growth, like early stage growth startups who are kind of building the plane as they fly. Like, how are each of these initiatives trending like month to month? It might take, it's too long to wait a year to see how these investments are actually panning out. If we just, invested in a new, again, onboarding team or activation team, we want to start to see that improvement month over month after hiring them. And if not, something's going wrong. And so this monthly view has been really helpful. I'll also add that having, these analytics streamed, whether it's through account name or something else, and being able to easily drill down goes a long way in kind of working through some of these issues and takeaways with executives. So you don't have to go deep into an Excel. You can actually click in month to month, see what has fallen off or expanded, and actually have that conversation, understanding the customer journey in real time.
Yeah, often when I build this for customers or clients, I show the MRR and monthly view. It's simple, it's more simple to understand. People can see it over time. And as regarding the initiatives, I actually really like to make sure, just for ease of clarity, to push marketing initiatives almost on a quarterly basis so you can actually see the differences over time, especially when it lines up with a company that has seasonality in the business. Oh, and good job landing Apple.
Thank you. It's easy.
All right, so let's talk about the strategic benefits for RevOps in this component. So I say strategic with a capital S, and I have a military background and strategy. The goal of strategy is to win the war, not just the operation to win a battle. And so I believe that strategic RevOps importance is the ability to drive enterprise valuation, which comes down to growth and efficiency. We use free cash flow margin as efficiency. And growth components are organic and inorganic, which we went through. We didn't talk about M&A, but that's a vital component as well. And then with free cash flow, you got to understand what makes up the calculation for free cash flow. So you need understanding of how to read a P&L and how to calculate it. This goes back to the idea, the more RevOps is knowledgeable in finance and can work with finance, the better you guys work together as a strategy team.
I just want to add too, Will, that this is like the framework, although it's like a little more technical and financy, this is the framework for like proving RevOps value to the company, which goes a
Yes.
long way in elevating your career and actually getting more resources too. And so I hear a lot from mid-career RevOps folks that are on lean teams, like, I'm drowning here. How do I get resources? And it's, well, you either have to show how you're growing top line or improving CAC, or helping with onboarding or enablement, like any of these efficiency metrics that actually move the needle on the P&L. And so I think this framework is super important in framing that up as an operator.
Yeah, and I have an opinion on that. I think too often people lose sight of where on the level or tier, like funnel metrics like CAC or unit economics like CAC go, or conversion metrics. Focus on revenue growth. My view is that revenue operations manage revenue. And so you start high level with these components. And so going back to this idea of revenue efficiency is this relationship between growth and free cash flow margin. And we know from Bessemer Venture Partners and Meritech, it's typically a 2-to-1 or a 3-to-1. And then this gets you to a number, and you can actually calculate and see where that stands compared to competitors, so you know benchmark. So this is a framework that I use help companies drive their valuation, and it is worked over time. And it starts with understanding how to calculate net retention rate through the waterfall, so you can see how to drive it, and then working on your budget and your staffing structure for sales and marketing. And that enables a CRO to speak like for like and help grow the company like for like with the CFO and really drive the value of the business and drive the business. All right, so let's talk about when should you do this, because this is complex. You need an expert, you need a tool, you need a team. This is complex. It's very powerful though. I believe companies should focus on having an effective revenue operations first. And the signal on that is, are you able to forecast within 5%? And I think people on the call right now just know I can do that or I can't do that. And that's really the clear signal. If you can't do that, then you work on these monthly business reviews, looking by sales and rep activity and funnel performance. And you use that to show revenue performance based upon revenue streams and quota attainment. And that will help you get the idea of what are the drivers of my business And once you understand the drivers, then you can drive to actually achieve target within 5%. Before you can do all that, you've got to have a documented go-to-market motion and framework, and you got to have a detailed understanding of your ICP. And when you're able to build an audience and then convert them on signals, you've got a motion, you've got movement, and then you can actually start being strategic. And this is where we get into VP of RevOps, building out capacity planning, bottoms up planning, scenario planning. You can get this ARR waterfall reporting. I would say do it first at a batch approach. And then this is where, hot topic, go-to-market engineering. Make sure you have a documented and clear go-to-market motion first before you apply Clay or Get Cargo and to run some of these engineering components. And then you have this idea of an effective strategic RevOps capability. And now your CRO and CFO have a very powerful team to turn to. And you can take a leap forward and be thoughtful about, do you leap into enterprise AI or integrate some MCP stuff? I would recommend understanding the drivers of your business and using a tool that can provide that real-time analytics. And once again, with account aim, the kind of decision is, do you have a data engineering team and data warehouse, or do you not? In that regard, using a tool like account aim can enable you to build that real-time analytics for your ARR waterfall reporting so you can be faster, which is so key right now in this fast-paced disruption cycle.
Yeah, I'm glad you mentioned fast too, Will, because I think even some customers do have an existing data warehouse, but the data team is so focused on product and eng, and RevOps gets bottlenecked, they don't get the support they need. So I think if you're ever feeling like you're not moving at the speed that RevOps needs to move at, that's when I think a solution like Account M can make sense.
All right, let's go into Q&A, James, unless you have anything else.
Yeah, no, Will, this is great. I really appreciate it. That was 4,000 hours of learnings distilled down into 30 minutes, and I found it super helpful. So folks, if you have questions, throw them in the Q&A and we'll tick through them. We had one about 15 minutes in, Will, that I saved for the end, and I think it's a great question with some nuance. The question was, I work for a usage-based company. How, obviously there's no ARR, so to speak, but how should they think about, the structure in waterfalls?
Yeah, great question. I tackled this recently, and I tackled this with healthcare specifically as well. Take the idea of the waterfall and think about revenue types. So you'd have a recurring revenue type, you have a variable revenue type like usage, and you probably have some sort of subscription or something else. And when you can see those different revenue types, that's how you build up your forecast. But the idea is you see them working in conjunction, and that conjunction, that framework, is your go-to-market motion. On the usage base, I highly recommend there would be some sort of subscription tied to that. So then you can identify from the first point of subscription, how's the usage change over time? And you can kind of get seasonality, but it's not just seasonality with like the calendar years and months. It's actually what's driving it in the market. And that's why usage is so hard right now. And that what's driving it in the market is often some sort of marketing content your team is putting out.
That's great. Thanks, Will. Any follow-ups there, guys? Keep the questions coming in the Q&A, or else we can give you all 5 minutes back. Going once, going twice. Okay, we'll see if one sneaks in. Otherwise, we'll close. I think, Will, this is great. My takeaways, there were many. One, ARR Waterfall is very complex. Two, really vital though for understanding the customer journey at scale. How do we start to get these proactive insights, understand what is actually going on and take action on them? Three, how do we use it to kind of frame up the value of RevOps? And I think what will stick with me is that map on when is the right time and what are kind of the layers of go-to-market maturity. So super helpful. I'll share some thoughts on kind of what's to come after this in terms of content, but any final closing thoughts from you, Will?
This is hard. So don't be concerned if like you do it and you get it wrong. And I would highly recommend, if you're trying to implement a company, work with someone like James or Josh or myself who have expertise in this.
Yeah, I was gonna say, if you have any questions, Will, like I said, is the best expert I've ever found to chat ARR Waterfalls. I'm sure he'd be happy to instill more knowledge your way if you have questions. He's been a great friend of the company, partner to us. So thanks everyone for the time. We will follow up with a recording, and we will follow up over time with some sort of kind of summary guide here, so this can stay top of mind and you can kind of reference it going forward. So again, thanks everyone, and thank you, Will. This was awesome.
Thanks, James.